Hey, good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. First and foremost, very big thank you, as always, to Mornings with Maria, Fox Business, Maria Bartiromo, for including us last week to discuss the ongoing dialogue with this Fed, with the markets, with interest rates. The story of the moment, macro stories, China, certainly long end U.S. rates. When you look at things on the ground here in the U.S., the UAW strike, the potential for a governmental shutdown here in the U.S., and obviously student loan payments. So a lot of cross currents in the market, but we've been writing and talking to clients about this notion of bonds and stocks within this pocket of time going down together, being correlated together. We've seen that rates go lower, stocks moved higher on Friday. We've seen now rates moving higher, stocks moving lower as we reprice to a higher rate structure, in particular, long and real yields. When we look at nominal yields, even real yields in 10-year space, 2 to 3% from a historical perspective is still within the realm of possibility. You look at nominal yields, you go back to the 2006-2008 cycle, you had a Fed funds rate right where we are right now, 10-year yield spending a fair amount of time within that context and that time frame between 4 and 5.25. So 450 is a number. It was our objective. We thought we would hit 450 before heading back to 4%, but certainly a move higher in yield can't be ruled out. Specifically, when looking at the yield curve, say the 2s, 10s yield curve, if you look at the SOFR curve, December 23 to 24, clearly the poster child for higher for longer, a continuation as the Fed formalizes fewer rate cuts last week in 2024. But if you look at that 2s, 10s curve locally over the course of the last year, negative 40 has been the higher end of the range, and we've achieved that in both directions. We achieved that with the March hiccup, where rates were moving lower, led by the short end. And then, of course, the pricing into March, with the Fed potentially going to 6%, and then the recalibration coming out of March through where we are now, with the reinversion down to minus 108 and UST 2s, 10s, negative 40 now, still 25 basis points away. Point being, we could certainly steepen more from here. We can certainly get to the upper end of that range, and we can certainly do that with longer end rates here moving higher as the 2023, as the months wind down here. The Fed tries to figure out whether or not they will go a little bit higher. But with the market pushing expectations for that out a little bit, with a lot of the cross currents that we're seeing in the market short term, and certainly the Fed saying, Chair Powell saying we could afford to be careful. The Fed speak is going to reiterate that. At the same time, we don't think they will take a further rate hike or rate hikes off the table, nor should they. On the ground this week, close eye, obviously, on long end rates, continued watch on 10-year treasuries. And in conjunction with that, most importantly, on Friday will be the Fed's PCE deflator, expected now to pierce back through 4% with a 3 handle for the core number, which we think will be most important going forward. And then lastly, Chair Powell saying to the press corps, don't pay attention that much to these base effects. If anything, the base effects could start to work the other way now. But having said that, the Fed watching now closely the month-over-month readings to extrapolate where they think this trend in inflation is, feeling more and more comfortable or not over time with the trend in inflation after a strong year 2023 of disinflationary forces. Wishing everyone a great week ahead. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.